Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. On today's economy show, we're going to look at some key pieces. So when we look at it in terms of what has happened with emerging markets, what is happening with others, we wanted to go a little bit deeper on what do we mean about emerging markets and the pressure that they're facing. So in segment one, we're going to look at emerging market pressure and why that is increasing, especially after what Lagarde said in the ECB meeting, and some of those knock-on effects as, negative yielding debt is at its lowest level in almost 5 years. And we'll look at some of those key pieces, especially, why we think the emerging markets could struggle, not so much on just the underlying economics of the local country and in terms of the consumption there, but more broadly speaking, when we look at pressure from the US dollar, pressure from global trade, and how that can impact and really start to leak into some of that local economy as we've talked about. Then we're going to go into what are the Fed rates looking like and the newest inflation data and wage growth, and where does that wage growth happen? So we've been talking a lot about how wages are going to grow. We're going to see that growth, but the question is it going to catch up and surpass where inflation is? And those are the key pieces that we want to look at when discussing how the consumer is changing and how those behaviors are going to get impacted. Then we're going to do the US GDP breakdown of Q4 and then tie in some of those leading indicators on what comes next. What are we going to see in Q1 and Q2 and beyond? Then, speaking back to Lagarde and what the ECB said, well, inflation, European inflation just exploded. So we want to talk about how high is it, what is happening with activity there, and how will the ECB react over the coming year. And then we're going to turn to Asia. We had some decent data points from India, Vietnam, Japan, so we're going to talk about that. But we also want to look at China, and now that they're in the Lunar New Year, we want to discuss what is happening with the consumer, what is happening with the local Chinese consumer, and are we going to see a big increase in spending? Because they rolled out dual circulation strategy, they've rolled out common prosperity. Where does the consumer sit right now, and could we see anything change in 2022? So now that we've gone through some of the high level, we want to start with and just give a brief update on where Russia sits with Ukraine. We discussed it in the EIA show briefly. But right now, Russia is meeting with China, and they're going to come out and show all this great support, and they're going to be supporting each other, and it's them against the world. But it's important to understand what is happening beneath the surface, because remember, Russia is a huge ally of India and has been for centuries. This is something that has been built over time, and it's important to appreciate where they sit in regards to if Russia had to make a decision between India and China, where would that decision fall? Right now, India is trying to work out a deal to get some of the additional fertilizers, because as for those that have listened to me and are in Mosaic, we have some shortages where Russia is going to stop the export of ammonium nitrate for 2 months. You're seeing a lot of disruptions with potash, so fertilizer is a very big component, and a lot of that goes into the India as a nation. So one of the other things that we talked about in the EIA show is that we have some European refiners that have stopped buying Urals just in case there's sanctions, just to make sure that is coming, how that falls. But that also means that India can buy more. India has been a big buyer of Urals based on the fact that they've been struggling to get Iranian barrels, and Urals is an easier way to sub into that. So this is just looking at some construction in terms of what continues to happen when you look at now given it's on the Chinese side of the disputed border. So it's not like they're building in the disputed area or in Indian territory, but it's something where they continue to show strength and building out the support system within that area. So the map is just highlighting where large-scale development of settlements by China near disputed sections of the Sino-China border are observed. As construction is ongoing, a definite purpose is still unknown, but most likely to populate border areas and reinforce territorial claims. So far, a total of 155 structures were counted with more under development. One location shows a cluster of close to 95 units being prepared. So it just gives you an idea of, China is very engaged in terms of strengthening this area. You can see how strategically speaking, when you look at Tajikistan, when you look at Kazakhstan, where a lot of these different places are, there's always been this push to claim and to create this buffer. And when you think about going from west to east across China, this has been a big buffer point, which is something that I think is very well telegraphed in the Prisoners of Geography book, as I am reading the second one right now. So then when we turn to Russia and we look at where Russia-Ukraine sits, this just gives you an idea on the airbase and the amount of equipment that is currently surrounding the Ukraine on 3 different sides. So this is just some of the important pieces that we look at. Most recently, and they made a big deal out of it, Russia has moved in blood and medical tents, which is typically the last piece that comes in following a potential invasion. One of the big problems or issues right now is that there's by no means an element of surprise. I mean, this is all very well telegraphed. All of these movements were well telegraphed. And it's so based on the fact that everybody's so prepared, it's just going to increase the impact or the loss of life. And I've already gone through in significant detail what I think is going to play out, but this is just another strenuous point. And with the Urals not being traded, now you're starting to see the differentials open up, putting a little bit more economic pressure on Russia. It'll be interesting to see where that reaction goes, how that carries out. But this just helps, I think, the OSIN, the Twitter handle below, fantastic follow. She, they have put together fantastic visuals. This is just one of them. And you can see that the detail that they go into. So it's something where give them a follow. They have some great updates on what is happening in the world, and they've been spot on so far with what is happening in Eastern Europe. So now we want to shift to the pressure. So if you remember last week, we talked about how emerging market earnings were going to be under pressure. We saw a lot of inflation. This is just showing an updated chart from the previous week where the 10-year government bond yields are now well over in positive. And when you look at just the dates, this says of February 1st. So you can get an idea of just how everyone, even Germany at this point, the 10-year government bond yields are now positive. Now this is nominal. This is not real. Real yields are still negative for a lot of these, but it just goes to show you the amount of pressure that is growing, and you're starting to see that shift. And there was a decent move on the German front and European bond front really after Lagarde spoke. But when you look at the manufacturing side, so let's look at the world manufacturing surveys. You can see that they're off their peak. They're continuing to slow down. It's still going to be in growth, but there's still more slowing to come. And when you look at that world level, you can see the PMI month change, how it started to essentially bleed down. And when you look at where those issues are, emerging markets ex-China, you can see almost a full point. And this is something that we think is going to continue when you look at the pressure on the emerging market front. When you look at emerging markets factoring in China, you can see that it was only half a point. But as we'll talk about in segment 5, there is more pressure coming into the Chinese markets as they've moved closer and closer to contraction, with some of the leading indicators already in contraction, which again just points to the pressure that we're going to continue to see. And just looking at, well, what does that pressure look like? What are some of the leading indicators? We've shown them multiple times in segment 1 and segment 5 of last week and the previous weeks. But this is just looking at the annual change in aggregate Chinese stimulus as a percent of Chinese national gross domestic product. So when you look at how that impacts some of the different pieces of when you look at global manufacturing PMI, you get an idea of just how there is additional pressure to the downside. China's, starting to balance out, as we've said, going to kind of bounce sideways. But this is just showing the amount of pressure that without Chinese stimulus, which we still don't think comes. We've had some nominal, easing measures, but again, as we've been saying, they're going to remain nominal. We don't expect a huge influx or a huge change. It's just these are some of the key pieces that are why we remain concerned, especially on the emerging market front, because as the dollar remains above 95, we have the euro that has strengthened, as Lagarde has said that they're going to have to reevaluate policy in March. And in my opinion, I do think that they raise rates in 2022. That is something that was not believed, in terms of around the market. It was viewed that it was going to be 2023, but I think more people are coming to the agreement that it's going to happen a bit sooner, given where inflation levels sit. So when you look at just why that's the case, you have to look at the CPI growth and the CPI growth year over year when you look at the different pieces. So when we look at goods inflation, then services, you get an idea of where that is around the world. That's the US, Euro area, different pieces. We are continuing to see pressure pulling it to the upside. That's across Canada, UK, Euro area, US. One of the things that we've been talking about is that Europe is a bit behind the US in terms of the speed in which the inflation has gone. And that's why we think that they're going to continue to catch up. And we'll talk more about that in segment 4 as to what are some of the indicators that we're seeing, how it's the fastest increase in history, and that's putting a lot of pressure. But as the developed world starts to see this pressure start to raise rates, remember the emerging market debt, where they have to borrow, where they have to roll, that comes under pressure because it typically prices off the 10-year. If it's euro-based, it typically prices off the 10-year bond. So you're getting an idea of where some of these pressure points are going to remain in the system. And here's just showing, just as we said before, where the negative yielding debt is. You can see that we're coming right back to where we were in March of 2020. And then before that, we haven't seen something like this since about 2017. So you're getting an idea of, again, pressure on bonds. You're starting to see that bid come up. And that's, again, going to, when you roll that debt, especially on the emerging market side, which has to worry about where's inflation, where's their local currency, this is going to become a bigger pressure point. And then when you look at labor costs, so the rising labor cost, the U.S. continues to be the outcropping in that, where you're seeing labor costs continue to increase. Other advanced economies haven't seen the same labor cost increases, but that's also a problem because how are people going to manage inflation or at least living wage increases if you're not seeing some of these costs increase in general? So again, that's another pressure point that is happening within Europe. It's starting to get better, but it's still not there yet. And we're going to talk more about that in segment 4. So just looking at the emerging market EPS, when you look at the money growth, and that's when we start talking about monetary drag, fiscal drag, as you have much less stimulus, we're in a rate rising cycle. We've seen it already. Now Europe is talking about doing it ahead of schedule. The US is going to continue to do it here. That's where, again, that pressure is just going to, again, pull it down as there's going to be issues at the company level in terms of, what are margins? What is earning power? So again, a lot of pressure that's going to remain in some of these companies. Now, as we remain in a rate rising cycle, to be very clear, we're still very, very low in terms of the ability for countries and companies and people to borrow. But it's just as we're coming into this rate rising cycle, you can see that the global financial condition index is now tightening, and it's tighter than before COVID. Just to give you an idea that this is continuing to go up. It's still easy. I'm not saying that it's difficult to get lending. It's not. It's just getting a bit harder, and the costs are going up as we continue to see this rate rising component. Now, there's also on a positive front, you're seeing a gradual improvement in auto production, which is going to be important for Germany, going to be important for Japan, US. So obviously, those are the key nations that it's going to be important for. There has been a little bit of a catch up in supply chains. There's also, again, some of that slowing demand, which has helped offset and pick up some of these production indicators. Now, the Bloomberg Commodity Spot Index, you can see that just on a commodity level, we continue to break to all-time highs. That's across food, that's across energy, all of these things leading to and supporting that flexible inflation level. But this is global. This is not just the U.S. And coming back to the emerging market pressure, who's that going to impact more? The United States or the emerging markets? And again, as most of these things, if not all, are priced in dollars, you get an idea of how much pressure that is going to put on the emerging market world. But when we look at commodity shortages, you're starting to see some of that adjust. So commodity pressures are easier per the ISM data. Less firms are citing commodities being in short supply and pricier. So you're starting to see a little bit of an adjustment. Again, it's a matter of when is this struck. This was struck as of December 31st. And that's one of the reasons why when we looked going into January, we were expecting things in terms of inflation slow down a bit. You're going to get some of that, the rate of change adjusting. But then when you look at what crude has done, diesel, gasoline, heating oil, that has not been the case. Instead, we've had a big shift higher. But on the iron ore side, on some of the on some of the industrial materials, that has gotten better. So on a construction front, on a manufacturing production front, it's looking pretty good. But then on a supply chain consumer level, speaking diesel, gasoline, it's gotten much worse. So again, it's just a matter of comparing the two. And this just puts it into perspective because as we came into December, you can see when we came into December here, they were starting to come down. You saw some slowing. But then as we looked at agriculture, it just exploded back to the upside and now is pushing back to where it was on the sub-index back to 2014 levels. Then when we look at it a bit further and broadly speaking, as we look at the commodity index, you can see as we got into December, things were kind of flatlining. There was some hope that it was rolling over, and then instead it just surged to new highs, breaking the peak of 2021. Now, when you look at what's happening in the U.S., and I think it's important to put this into perspective, perennial money-losing companies, number of companies in baskets of the basket continues to rise. Again, this is just companies that need debt to continue. They can't they can't manage because they don't have enough cash flow to keep themselves afloat. So they have to continue to rely on the borrowing world. And as rates go up, the cost of doing that also goes up. But without fear, the retail investor keeps buying U.S. stocks despite sell-offs. Market volatility in 2020, not yet enough to keep some retail investors from putting money into U.S. equities and ETFs. Smaller investors have been net buyers every day so far this year, as tracked by VandaTrack. So you get an idea of just there's been an endless amount of buying, even though there's been a lot of volatility on the bond side, on the VIX, looking at stocks, but still everybody's in the buy the dip mode. Now, when you look at the commodity index, again, the commodity index, broader dollar, the dollar, as we've been saying, has really disconnected from where commodities are. So typically, we do think you're going to get this starting to turn around, which. Now, to be clear, I don't think we get a move to 100 in the U.S. dollar. It's more along the lines, there's a lot of reasons it stays here. It's expensive on some metrics, on others it's cheap. And that kind of competing factor, especially as the Fed continues to talk tightening, is accelerating their quantitative tightening. That is going to, again, put more pressure and support the dollar because in the near term, I do think that Powell and the Fed will protect the dollar over stocks because they do want to protect, the U.S. dollar and what that means going forward. And this is just going to look at an example because the Brazilian data was terrible in terms of a lot of slowdowns, a lot of headwinds. And this is just showing you one specific area where the Chile monetary policy rate, there was a big surprise to the upside. Everybody was expecting an increase, but not to this level. So again, this is just showing some of that pressure that remains as the emerging market world tries to get in front of the inflationary pressure, tries to stay ahead of it, and it's starting to result in much bigger slowdowns on a local economic level. So now that we've looked at that, we want to talk more about what is happening in the U.S., especially as we see rates, bleeding higher, and what is going to happen to the local consumer as retail sales slow a bit on a real level, as wages really haven't been able to keep pace with inflation.